US inflation data has been very volatile from month to month, and the full impact of tariffs is still to come. Add renewed conflict in the Middle East, and we're likely in for more market swings. We expect the Fed to hold rates steady this week as it waits for clarity on tariffs. Ongoing inflation pressures from a tight labor market will limit how far it can cut rates this year. Inflation rose less than expected in May, but wage pressures are still too high for inflation to settle at the Fed's 2% target. We're starting to see tariffs lift consumer prices, think appliances, but the full effect is still ahead. Longer term, we see megaforces like aging population and geopolitical fragmentation and the AI build-out adding to inflationary pressures. US growth has also been volatile, strong one quarter, shrinking the next. And trade policy shifts add to uncertainty. But hard economic rules, like how supply chains can't be rewired quickly without disruption, act as a constraint, as we've seen in US-China trade talks. And we brace for more policy-driven volatility as the 90-day tariff pause ends on July 9th. Looking outside the US, tariffs and any sustained rise in oil prices could mean weaker growth globally. The European Central Bank cut rates this month, but signaled a pause ahead, even after lowering its 2025 growth outlook. We think the ECB has more room to cut as wage pressures cool, growth weakens, and softer demand helps inflation subside. Volatile economic data, like the CPI, reinforces our view that we're in a regime of greater macro volatility. We expect the Fed to keep rates steady, and megaforces keep us overweight US stocks.